The market just refuses to crash. This morning's red-hot inflation report gave sellers once again another chance to gap and go lower, and once again, those sellers completely failed. Apparently, there will be no Michael Burry of 2025. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got one additional trade idea to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off on the SPY daily time frame chart, and all we want to do here is evaluate what's taken place relative to our base case situation that we described on Saturday. Remember that the base case outlines a low, we have the highest high in the trend count, the DeepSeek gap down was the first possibility of a daily high or low. The tariff gap down sort of negated that. However, because of the severe and prompt recapture of the key level, we're still willing to call this a higher low in the trend count, and the next ideal higher low is above 599.65. We talked about this on Saturday. We talked about how it keeps all of these traders, anybody who bought the dip, so to speak, after the DeepSeek move here, after the tariff move here, a majority of the overhead supply would come from a potential breakdown underneath 599.65. So let's rewind. Let's go to Monday and Tuesday of this week with the understanding that our key level for the week was 599.65. Of course, Monday and Tuesday are just inside bars relative to the Friday session of last week. Now, if we think about what Friday of last week represents, it's an outside bearish engulfer of the Thursday session. So, is it reasonable that the bearish engulfer is representative of some sort of bearish momentum into the key level? In my view, the answer is absolutely. So to see the Monday session open higher away from the low of this bar, away from the key level, and sustain that sideways consolidation on the Tuesday session, even after a mild Tuesday gap down, that's an indication that sellers weren't really there early in the week to pressure markets lower, and we never even came close to testing the key level. So strike number one from the sellers. Even with that Tuesday gap down, we closed near the high of the session on Tuesday. Now, of course, today's session throws a wrench in the mix because there's a big gap down on the inflation report this morning. Inflation comes in hotter than the expectations. The market throws a little bit of a pre-market temper tantrum. And lo and behold, where do we gap down to? This is important. We gap down not only just underneath the previous day's low, getting outside of range, but we gap down underneath Friday's low, underneath our key level at 599.65, right to the daily 50 SMA. So let's ask ourselves the question. If we had stronger sellers participating in this market, what should have, in theory, been the continuation play here for sellers to trap all of these traders as overhead supply and, quote, crash the market to the downside? Of course, a gap and go is the most favorable outcome for a seller. Did that take place? The answer is obviously not. We close at the high of day. So, okay, there's no gap and go. The next most bearish thing that could take place is a partial gap fill reversal, something that looks into the gap a little bit, reverses, and then closes at the low of day. Does that take place? The answer is no. What about a full gap fill reversal? The answer is no. You get what I'm getting at here, right? And as mentioned in the introduction, sellers have failed once again. What have we learned from this market? Gap down, sellers not here. Gap down, sellers not here. Even in the Sunday night session futures, while there was that new tariff news being announced, futures technically opened up on Sunday night down here, promptly rallied, and Monday was A-okay inside of Friday's range, right? So stronger sellers are just non-existent on the daily time frame chart, and the base case lives on with a beautiful hold via the gap down of this 599.65. There are a number of different outcomes here that would have suggested more of a bearish deterioration on the daily time frame, but it's just not what we have on the screen in front of us. We've closed inside of the Tuesday range. If anything, sellers should have started pressuring markets to the downside, trying to reject a close inside of Tuesday's range. It just didn't take place. So the base case lives on, and from this point forward, this is now just continuing to act as the higher low on the daily trend count, and ideally, we're trying to work our way back up towards the equal high, which in this case happens to be the all-time high. That's up here at 609.75. Of course, there are some levels in the way, and we should be respectful still of 606.75, but generally speaking, on the daily time frame chart, we're still trying to navigate towards this target, the upper edge of the weekly expected move. So all set on the daily. We know that the uptrend remains intact. Something that we can do here, and we will do, is coming in from the bottom to the top, just to reinforce one more time that even the gap down from inflation this morning was unable to break the market down underneath the 38.2, technically classifying all of this, in my humble opinion, as bull flag consolidation, waiting for some kind of breakout up and into blue sky territories if we can see the follow through from the buyers, right? Because it's one thing to have a market that's not a short, but just because something's not a short doesn't mean it's a long. There's a big difference between the two. So with that understanding, we'll drop it down to the hourly time frame chart. We'll get even more granular here. It's really not much to dive into other than just one more time, the sellers completely failed. I mean, notice that you opened underneath the key level. You opened underneath Friday's low. There's a little bit of a flash to the downside, but almost instantly back higher. Now, one thing I will acknowledge here is that the midday candle, it's actually the second hourly bar of the session, so it's maybe not midday, mid-morning, if you will, does produce a sizable upper wick where it closes down here back in the midpoint of the first hourly candle. If there was an opportunity for sellers to produce a stronger gap fill reversal, I would have thought that was the moment right there. Like, okay, there's been a pretty severe reaction off of the full gap close, off the 2-day lows from the balance range up here. Maybe it's sort of, a retest, close the gap, and then we move lower underneath the opening print. Obviously, the third hourly bar of today's session basically opens, takes no looks to the downside, does not break the second hourly candle's low, and closes over the second hourly candle's high, which is important because it's an inverted hammer, right? So all things considered, sellers, they had somewhat of an opportunity intraday, but even that opportunity has slipped them by, and I would not say that this chart is reflective of stronger sellers being active in the market currently. So the hourly trend count, what does it look like? It's probably a bit more neutral in this box. It's trying to flip back in the upward direction with lows. Technically, we had higher lows. This gap down puts in a lower low, right? So at this point, the next major outcome for the hourly time frame chart is some kind of break. You could use a trend line that looks like this. You could use a horizontal level somewhere in here. I don't want to get too level happy, but any sort of move back up here starts to suggest a pie in the sky double bottom. The main level where I would say you possibly have a breakout trade on your hands is something along these lines, over the rejection point from Friday of last week at 606.75, which is what we were talking about on the daily time frame chart just a moment ago. If the sellers are going to produce some sort of threat to the downside, we need to see tomorrow morning almost an instant move back down underneath 603.25, underneath the Monday, Tuesday lows of the range there, and then some kind of consolidation does what? Maybe this sets up as a descending triangle over time. Maybe if you want to make a stretch of the pattern here, it's some kind of lofty head and shoulders with a double right shoulder. Your neckline maybe looks something like that. The point is not to be overly, picky about semantics and getting the wording right. It's to understand the trend count. If we do get another equal low and lower highs to pair with it, then of course there's going to be some kind of threat here at 599.65. But as we've talked about so far in today's episode, there's no evidence that even with a catalyst, stronger sellers are choosing to participate and sell the market short or just bail on long positions on these big gap downs. When I say big, obviously relative to what we had on the Monday and Tuesday range back here. So that's my interpretation. Stronger sellers still not here, looking for long opportunities in the upward direction, and ideally for the move to the all-time high, it's just this as a double bottom on the hourly, Brigade bolt above, target that 609.75. If it is going to become a short, it probably requires a little bit more patience, something that builds out over time, and then we'll play it one step at a time if we get this Brigade bolt to the downside. If we are presented with short opportunities underneath 599.65, I would really treat these as independent opportunities. I would not be like, oh my goodness, market's crashing, going to zero. I think I would just lean back on the daily time frame trend and say, okay, yes, we're technically underneath the level, but where are we relative to the overall range that we've been trading in? Remember, a breakdown of this area just puts us in here. It's really just the midpoint of the range. Do we really have a bold claim to make in the midpoint of a balance range? Not usually, right? On the hourly chart, I do want to show you guys the intraday anchored view app spread and the fact that we opened underneath that spread, a majority of these three over here. If I just zoom this out, you can see where they're stemming from, so we include this back there. You get the idea, right? We gapped underneath, we held this one. This is the original anchored view app from back down over here, the lowest low in the range. But in theory, the gap fill reversal would have also kept the sellers in control from a VWAP perspective intraday, these anchored VWAPs, right? So the fact that there was no rejection or follow through underneath that, and we actually closed back above into the afternoon, does strike me as more of a bullish undertone there. If we come in with the Fibonacci's, what I want to do is start from the tariff gap down low up to the Friday high of last week. We gapped down underneath the 38.2. You can see it's right here. It's kind of hidden in that cluster, but that's another opportunity where the sellers could have stepped up and persisted for like no man's land. No man's land is between the 38.2 and the 61.8. No man's land could have been a reasonable outcome from today's session, but where did we close? Once again, over the Fibonacci 38.2, which is this blue level right here at 601.37. So once again, not really seeing stronger evidence of sellers stepping up to the plate and trying to drive this market lower. If we take a look at the market internals, this is going to reinforce that, but to a lesser extent, which is where we have to start considering some of the counter data points. So if you're not familiar with market internals, first of all, check out the video tutorial in the top right-hand corner and brush up on what all of this is. The first thing I'll point out is just the internals from today's session, and then we'll look back at Monday and Tuesday. So Wednesday, although yes, we rallied from the gap down, we didn't really put in solid volume flows here, and if I do something like hide the cumulative flows, you can see that the breadth ratio through the duration of today's session was actually primarily negative. There's only a small period of time where we flipped over the zero line. If we look at the advanced decline line today, it opens in trend lower zone, and I'll give credit where credit is due. I mean, we did grind out of that, but it's not like we were testing positive. It's not like we ended the day up here in trend higher zone. The tick itself was also fairly lackluster on today's session, which is somewhat surprising because this measures from the previous day's settlement, same thing as saying close, same thing over here, it measures from the prior day's close. This obviously measures on a tick-by-tick basis. So the fact that the market was rallying so firmly to get back inside of Tuesday's range, and the tick itself was somewhat lackluster. I mean, you can see that the cumulative, and this is the whole reason we sort of built this, right, is to understand what the aggregate is on the day. It actually closes negative. So did we have stronger buyers really stepping up and, going all out at the exchange level? Hey, let's buy this dip and let's, everything's fine and dandy in the market. Not really. And this will tie into some of our analysis of the sector posture as well when we get to that segment of the episode. So just understand that although, yes, we did see the counter trend move and sellers didn't run away with the gap and go, it's not like the buyers really showed up in full force here. So that's one note. If we look back to the Monday and Tuesday consolidation of this week as well, this is where we can maybe extrapolate a little bit further and say things like, okay, in general, during the consolidation, did we have stronger sellers, selling through this? Should we have been expecting a breakdown, or was it more so neutral? And this is where I would reinforce, okay, now I can sort of back up and say, okay, yeah, it makes sense that stronger sellers still probably aren't here. Notice on Monday, volume inflows, Tuesday, lackluster and flat. Over the zero line on Monday, closing at the zero line after an impressive recovery on Tuesday. If we look at the cumulative build, Monday, it's not the strongest read I've ever seen, but it is positive, and Tuesday is basically benign, very flat, almost at zero. So did we have stronger sellers during the two-day consolidation? Were people like secretly unloading all their shares at the exchange level and preparing for this big dump? Not really. We didn't see that, right? And again, I'll fully acknowledge here, like, this is not the strongest volume inflow. It would be better if we were over 300 million. It would be better if the cumulative build was up and over 5,000. It would be better if the index score was over 20. But the point of the episode, right, and this is a continued reflection on the market, is the market's had every opportunity, catalyst or not, to break down. DeepSeek, here's the tariff news. We had more tariff news over the weekend. We have week forward guidance from earnings. We had Jerome Powell. We had the FOMC. We had all of this stuff going on. This morning's hot inflation print. And yet, what does the market do? It continues to rebound off of these gap downs, just illustrating that, once again, in my opinion, there are no firm evidence points here that suggest stronger sellers are getting, active and willing to auction the market lower aggressively. Let's finish up the S&P 500 with our good old friend, the market profile. If you're not familiar with this sort of chart type, check out the video tutorial in the top right-hand corner. What I want to focus on here today is that the gap down actually did a number of things to repair some previous poor structure. The first thing I'll do while it's zoomed out is draw this level in right here. And we could probably bring this slightly lower as well. Maybe it's more accurately, something along these lines. Point being is if you take Friday's low, if you take the lows of this, which could be considered overhead supply, if you take the lows or a majority of the value from here, notice that this is intraday value, intraday value, intraday value, and of course on Friday, intraday value is here. If you take that and compare where today's value is, and I know it's zoomed out and we'll zoom back into it in just a moment, but I at least hope you can see that the point of control, this yellow line I'm pointing to right there, is above the 60-50 level, 60-40. We've been using 60-65 as a key level as well. Value area and the point of control did migrate higher today with price over the low end of what I would consider the overhead supply threat, right? So the gap down here, this is where we opened today at this box that I'm pointing to down here, gave the threat for the potential. This is why a partial gap fill would have been so dangerous, right? Because it keeps all of these traders as overhead supply. The point of control and value area, as I've said already, moved above that level. If we had stronger sellers, the auction should have continued in the downward direction. A majority of the volume should have been committed underneath the level, and it just simply didn't take place. Now, if I zoom in a little bit, remember that we sort of had, in this view, the L period looks like a little bit of excess on the lows, but this was pretty mechanical here across the next distribution, if you will, KLM during the JKLM periods in there. That's sort of mechanical and in theory could use some repair. Now, this is the proper end of the auction with L extending through the bottom, so I'm not going to try to stretch this, but generally speaking, the fact that we opened underneath one more time would just mean if this value is going to weigh on price and we've just repaired this, this is the spot where you're looking for a rejection, and it just didn't take place. One more time, where's value, where's the point of control today? It's higher in the session. The point of control is clearly over half back, which is the purple line on your screen here. Purple, blue, I don't know, maybe I need an eye check, but that's what we have for the market profile. The next biggest takeaway would just be that we do actually have a poor high from today's session, right? So G and H period, if that needs some repair, we're expecting a break over today's high. What would the target be? Of course, just the top end of the 2-day balance range. So that's giving you about a 15-point trade up towards 6,100 if we take out today's high in the subsequent session Thursday or Friday. If we continue to consolidate up here, I would argue that the next biggest hold, the next most important thing for the market to hold is no longer we cannot afford another move underneath 60.45. I'm trying to tie that in with the value area low. It's slightly higher than that, but that would be the technical level, 60.45, which is the equivalent basically of this down here. Friday's low at 599.65. As long as we can stay over that, the base case lives on, and we'll continue looking for these longs, right? So that's the market profile. That is your market internals. That is the S&P 500. Let's move along to the QQQ nasty NASDAQ 100 and see what's going on from this point of view. We have ourselves the balance range in here, and it's very possible that the NASDAQ is trying to follow suit with the S&P. One of the comments we had made on Saturday was just that this balance range is, it's exactly that. It's much more balanced than that of the S&P 500. The S&P is clearly trying to set some higher lows towards the top end, whereas the NASDAQ's a little bit more sideways. So with today's hold of the 50 SMA, the hold of Friday's low, the closure inside of Monday and Tuesday's range, it strikes me as a step in the right direction to trying to build out a set of higher lows in the balance area. So 522 probably just deserves to become a firm level, not a dotted level anymore. We'll hold that on the chart. And as long as the consolidation stays above, the daily trend is trying to flip to up, right? We have lows, higher lows, and the name of the game is really trying to navigate up towards the all-time high. Some sort of breakout of the balance range does that for us, and that would be up and over 533.25. So we'll keep that as a base case situation that continues to persist on the QQQ daily. As we consider maybe something that would break the QQQ base case, it would start to become some sort of violation of 522, right? If the market rolls over, puts in consolidation here and breaks, I almost would still be open to 518 acting as a key level just because the market's not really trending in this box. We're not pulling back from the highest high in the trend count. We didn't make it up here to the all-time high retest. So I would treat this as an independent opportunity from A to B and just understand that you're in the midpoint of the range. If we start getting towards the lower portion of the range, concerns would emerge or increase, I should say. However, in a range trade, and we've seen this over the last month and a half or so, maybe even more than that at this point, 2 months, you've got to treat the range for what it is, right? Longs have not really been rewarded towards the top end of the range, and longs have been rewarded from the bottom end of the range. From a risk-reward perspective, right, something along these lines is more attractive as we come into the lower third of the range until there's some sort of Brigade bolt that holds acceptance outside of 533.25. So that's a consideration here on the daily time frame as we continue to sort of talk about and describe just how much more neutral the NASDAQ is versus the S&P 500. So that's your daily here. Let's move on down to the hourly time frame chart. Looks like we still have our moving average, anchored VWAP cluster, which is somewhat, it's fine that it's there already, because what does it suggest? We're above the entirety of the cluster. We did not gap down under any of it. We actually gapped into the midpoint. We gapped into the 50 SMA. We gapped into Friday's low. Great hold. One more time, just like the S&P 500. If we evaluate the second hourly bar of today's trading session, it was a rejection of the Tuesday low, but did we see follow through underneath the second hourly bar? The answer is no. We start getting multiple hourly closes up and inside of the 2-day balance range, which to me is a failure from the sellers to produce a gap fill reversal and pressure markets underneath the opening print for some sort of deterioration back towards the low of the balance range at 510. So we've been stuck in this balance range. We've known that stronger sellers are not emerging, and that has not changed here over on the NASDAQ. The next phase of this really just becomes, can we finally see some sort of acceptance up here where there's not a catalyst to drive price lower, there's not a tariff announcement over the weekend to drive price lower, there's no Chinese AI to drive price lower. Can we find acceptance over 528? Can we get a break and Brigade bolt over 533.25? That becomes the question. Until proven otherwise, towards the top end of the range, I think we just want to be cautious, right, of our trade location. If you're trying to swing something long, at some point, let's not be foolish and oblivious here. At some point, the market may break out of the range. But is it wise to preemptively front run that and try to get long here when historically we've seen that buyers are not rewarded towards the top end? I think you want to be cautious about your trade location, as we were mentioning with those swing opportunities. Probably risk reward favors the longs at the bottom end of this range. Now, I don't want to go back down here from a price acceptance perspective, but location wise, the next long trade needs to come from some sort of proof that markets are trying to hold up over 533.25, which once again stems back to my original comment on the S&P, which is just that sometimes, although something might not be a short, and that's what I'm sort of saying about this market, I don't think it's a short up here at the top of the range, it also might not be the easiest long based on the evidence that we have in front of us, right? Let's move into the NASDAQ internals and see if this is confirming sort of our hunch that stronger sellers just aren't here. The answer to me is yes. This is a stronger display out of the internals from today's session in particular, out of the NASDAQ, out of the NASDAQ, apologies for that, versus the S&P 500. Notice that the volume inflows are slightly more substantial, although not at 400 million. The S&P was just sideways to slightly lower, under zero. The advanced decline line gets more meaningfully towards the zero line, but not positive, so we'll take that at face value. And the cumulative build here is completely flat, but it is positive relative to the negative read we just saw on the S&P 500. So, NQ, all of the suspicions are confirmed here. Stronger sellers are not in the market right now, but today's session was really not the best display of strength. I wouldn't go out there and say like, hey, let's just start buying the NASDAQ because everything is firing on all cylinders. It wasn't. You would have seen a stronger move up here. If that was the case, you would have gotten to trend higher zone and all of the ticks would have been over zero. We just didn't have that. Let's take a look at the NQ futures through the lens of market profile. See what else we can learn here. Let's zoom out a little bit. And this week, I think all of the my apologies today. All of the analysis that we saw over on the S&P futures really happens over here as well. I would say that the gap down was not as severe. It did not leave as much of an opportunity for potential overhead supply here and overhead supply happening here. We gapped, yes, underneath or towards the low of Friday's session, but not underneath both of these boxes. We did see value area move higher with price, as did the point of control. You can see that as I zoom in here a little bit. Not quite a double distribution in C and E periods, but not as much of a poor high either at the top of today's session. So walking forward, what's the name of the game? If we just go back over to the platform, if we take a look at the QQQ hourly, I am just going to remove the study set there and just go back to our daily 50 and 200 SMA. The name of the game here is really watching 526. I know I maybe wasn't as prescriptive about this on the NASDAQ just a moment ago. We sort of skipped ahead to the VWAP bands anyways. If we can hold over 526, that would start to become intraday risk reward to the upside, right? If we can get that hold, I'm sort of more partial for upside because of the failure of the sellers and that acceptance inside of the Monday and Tuesday range. So we'll leave it off at that. Maybe there's an independent scalp from here to here, thin structure retracement, be my guest. Do you want to overstay your welcome on the short side? Probably not. We know that in general, we've remained fairly neutral about the NASDAQ. We've tried not to make any bold calls as we remain inside this sideways box here. So that's your cues. Let's take a look at small caps and see what we can see. Really, geez. Apologies for this today, the coughing there, but I do appreciate you coming out to the show regardless. Hopefully the information is worth sticking through it. IWM small caps, the breakout level, the new balance is in jeopardy, right? So that 230 level is not really in play for the remainder of the week unless there's some miraculous gap up into the end of the week, which I wouldn't really forecast. The economic data is always going to be more influential over small caps because of the operating environment. So is it a surprise that the small caps gapped down more substantially underneath the range low? Is it a surprise that they ended up putting in a decent gap fill reversal? I think the answer is no there. I think falling out of the balance range makes sense that more aggressive sellers would participate. I think it makes sense that there's a gap fill reversal underneath the Tuesday low. And I would really think that 225 is going to be the gatekeeper into the end of the week. Do we see the reversal all the way back down into the 230 mark? In which case, obviously that's going to act as a small headwind to the S&P 500, but it's just bearish for small caps, right? I don't think that with the hot inflation print this morning, small caps are overly jazzed up, if you will, about Elizabeth Warren's request for, oh my goodness, Jerome Powell, you need to cut rates tomorrow, right? That was just kind of crazy what she said in her interrogation, if you will, during Jerome Powell's testimony. But regardless, the 225 level remains key. We will either reject that and we'll know that small caps are signaling, no, we're not going to get rate cuts in 2025. Or if we move back into the new balance range, maybe we become a little bit more optimistic about the rate cut campaign from Jerome Powell and, all those who wish rates were lower anyhow. So 225, no need to overcomplicate things here on the IWM. Use the new balance range, #NotSponsored, as your guide moving forward. Let's take a look at the hourly time frame chart just to see some of the differences here. Notice that there's really not as much, even on Tuesday, right? You're underneath Friday's low as of Tuesday's open on the gap down. Tuesday does reject the Monday range, so Tuesday's a gap fill reversal. That's your first indication that, the small cap side of the market's not really performing that well. And of course, today, here is your major gap fill reversal underneath 225. I still think that there's technically a little bit, there you are, a smidge of the gap that remains unfilled. So if we were to take the same approach in terms of saying, do we have stronger sellers present here in the small caps? The answer seemingly is not the same as the S&P and the NASDAQ. The answer is almost, to some degree, yes. We're not holding over the key area. The key hold for the small caps would have been that this acts as your higher low from here to here, and we rotate back to the top of the range and eventually break the new balance range highs at 230. Certainly not the case with the gap and go from today's session or just the gap fill reversal, pressuring small caps into the end of today's session. Let's move into our anchored VWAP look underneath the entirety of the cluster. So obviously one of these things is not like the other. Let's move along to the small caps internals, Russell internals. And what do we have here? More bearish on the Monday, or just, I suppose, neutral is the takeaway on that. So neutral volume flows, bearish, not really crazy on the week. The cumulative builds, kind of a mixed bag down here. This is a bit perplexing as well, because even as I look at this, and I'm seeing this for the first time with you this afternoon, I was not watching this intraday. The Russell internals don't really suggest that sellers were pedal to the metal. Oh my goodness, let's bail on everything small caps. Now, it's still underneath a key level, and I would respect that level until proven otherwise. As we just mentioned, it's 225. But if you take a look at the volume flows, it's not like it was sell everything. If you look at the advanced decline line, there was a recovery effort here, and the cumulative build somewhat flat. So keeping an open mind for the Russell, but price is what pays, as we all know. And if we're under 225, I would tend to think there's an opportunity for a sustained lower high, which rotates smalls into the downside here at 220.25. Let's move on over to the IWM, or I should say Russell. Let's go to the Russell market profile, and let's see what we can learn additionally about this market here. what do we have? Instead of comparing, well, not instead of, but rather let's compare to Friday's low and just see where value area is. It's certainly underneath. Point of control is underneath. This is definitively a bearish breakdown from the overhead balance range we were just talking about on the actual candlestick chart here, this New Balance range. So bears have more of an edge in small caps. Is anybody shocked? Not really with the hot inflation print this morning. Let's get back to business with the S&P 500 and look at some supporting evidence here through the lens of our S&P sectors. Weekly performance so far is a little bit of, here it is, it's a white flag. It's not a red flag. It's not an, oh my goodness, sound the alarm, markets are going to crash and go to zero. But look at the sectors that are leading the posture here. We have consumer staples, which is defensive and also a lightweight sector. Now, the market's not breaking out to new all-time highs, so should we give it some leeway? Maybe a little bit, but the recovery effort today in particular was quite strong. So led by consumer staples, followed by utilities, also D for defensive and also lightweight, and then it's the semiconductors, and then it's the XLK. So posture here is a little bit of a white flag, as we've mentioned, and I think that this neutralizes some of the analysis. You know, although, yes, it's fun to say, like, hey, stronger sellers aren't here. Oh, my goodness, the market's got to go on and break to new all-time highs, right? This grounds us. This brings us back to earth. And I think we sort of have been doing that anyways with the market internal, saying, hey, just because it's not a short doesn't mean it's a long. You know, trying to navigate that neutrality and not getting overly biased as we're really just still stuck in a balance range. This is another one of those neutralizing data points here. At the bottom end of the barrel, it's the TLT gapping down big time this morning on the hot inflation print. Not a shock there. It's not an S&P sector, so underneath we have discretionary. That's a red flag. Discretionary is a heavier weight risk on sector. We have financials, second heaviest weight risk on sector, also down more than 1% this week. So, you know, posture here does not look fantastic on the recovery effort, even from today's failed gap down from the sellers. Let's move into these individual structural charts and see what we can learn. Consumer staples breaking out over these highs, but is it making a brand new swing high? Are we making a new move over this? The answer is no. So for now, I'd say upward pressure is just upward pressure. We're thankful for this to keeping the rotation alive in the S&P 500, but we don't want to see this act as the leader if the broad market makes a brand new all-time high. Same comment over here out of XLU. It's really more so sideways, slightly above a key level at 77.50. As we move over to semiconductors, it's still stuck sideways inside of this range. I would have thought with the Monday breakout from NVIDIA, and we'll talk about that in just a moment, I would have thought that semiconductors as a industry ETF here, the SMH, should have been inside of its overhead gap. Remember that this is the DeepSeek gap over here, or at least what remains of it, and there was no move into that over 251.50. So is that slightly perplexing? Is it slightly concerning? I would think the answer is yes. This morning we did get a gap down. It did not stick. It was not a gap and go, and we're still inside the midpoint of the original range from back here. So I'm not trying to sound the alarm. I'm not trying to say, oh my goodness, semiconductors have failed, but I am just slightly cautious of the idea that with an NVIDIA breakout, why are we not seeing that liftoff towards the gap close area, or at least the top end of the range at 256. So I'm going to continue to monitor 251.50 here very closely into the end of the week. Obviously, the most bearish case is a Brigade bolt lower underneath 237. That does not appear to be a threat into the Thursday and Friday session. Let's move along to the XLK, which is also stuck in a range. Notice that this did attempt a little bit more of that gap close overhead. Today's gap down was recovered, of course, and I think that there's the possibility that we continue to try for this into the end of the week. If that's the case, that will help the bull case for the S&P 500, watching that 235.80 quite closely. If you take a look on the hourly time frame chart, right, you can see in the afternoon sessions here on Monday and Tuesday, a majority of the price acceptance was over that 235.80. It's just a matter of, can we get back there? Can we continue to suggest that price acceptance? In which case, the full gap close to me seems somewhat inevitable the more time we spend over 235.80. If we cannot get up over that level, then anybody who tried to buy this breakout, right, if this turns into a rejection early on in the Thursday session, you know, just watch that very closely. If that's the case, you have trapped overhead buyers from the Monday, Tuesday, which could potentially be fuel to the fire for the downside. Now, in a picture perfect world, there's no further retest of 230.25. After this breakdown from Friday, right, we sort of set some kind of low in here. We do not want to revisit 230.25. Ideally, we want to stay over the bottom end of the balance range from in here and not see another test. Show me the love to the upside, show me that gap close, and then we'll look for the higher low on a retest over 235.80. Moving along to the TLT, just to talk about it, the swing puts, the swing short puts have been closed out. That was closed out earlier on this week. It was the Monday session, actually, as we were going sideways up there. And for now, excuse me, apologies, I'm dying over here. For now, we're back at the right shoulder, or even the left shoulder, of the inverted head and shoulders. And with inflation the way it is, I gotta say, I'm a little interested to see if this wants to get continuation to the downside. I think that PPI tomorrow morning could also act as a catalyst. If PPI comes in hotter than the expectations, probably looking for a TLT move again in the downward direction, in which case I might even try a rinse and repeat, basically, of a short put sale underneath the 85 strike. We'll see if the 84s have any good premium in them for something closer to the end of February. See if we can capture some of that. And if we get assigned to 84, then so be it. We'll farm the yield. And it's the same rinse and repeat process there. So watching TLT into the end of the week for a potential short put sale there as a swing, which is kind of rare for me, but we'll do it if the premium's there. XLY, not the greatest display of strength, and we mentioned that in the posture overall. Reason being is that in a picture-perfect world, this, right, would have suggested inverted head and shoulders over the neckline, rock and roll to the all-time high. It's just obviously not working that way. So these rejection lower highs become concerning. Yes, there's the opportunity for like weekly double bottom. We're not there yet. I would not make that assumption. Obviously, it's not a double bottom until it is. You need to break the neckline. But a hold of 219.75 at least keeps the weekly hanging on to a neutral trend there. Still probably a weekly uptrend. Any violations of that, though, do become another red flag. We can even use like the warning sign as we walk forward. Okay, so 219.75 key watch there. Financials, they technically look fine to me here. Yes, they've pulled back. Yes, they're underperforming on the week, but I mean, they've been outperforming for so long that a rotation is somewhat inevitable at some point in time. It's just a matter of whether or not the technology sector can pick up the baton and really run with it. As of right now, the answer has been somewhat lackluster. Let's move along to healthcare. Healthcare is trying to build out the inverted head and shoulders here for the weekly reversal. I would like to see this turn into a daily bull flag, call it the inverted head and shoulders, whatever you want, but ideally it's just another break up and over the pivot high. We've made a low. If this sets as a higher low, if this is a high and this is an equal high, all we need is that next higher high, and we can confidently say, okay, the daily trend is back in the upward direction. We're not there yet, but we're pretty darn close. The daily bar close from today's session is not all that inspiring. However, I would give this the benefit of the doubt over 143.45, watching that level very closely here. Moving along to real estate, lightweight sector, rate sensitive, obviously gapping down with interest rates moving higher this morning. Recovery effort, yes. Let's take a look at the XHB. And let's see what happened over here this morning. Gap down, which did not close all the way. It continues to look really weak on this H pattern here. Anything through these lows becomes concerning. We know that this certainly is influential over the cyclical side of the economy. Let's continue along to energy. Energy's sine wave is compressing, right? You're getting a little something that looks like this, classic little symmetrical triangle. I don't think there's a bold call to make in the midpoint of this, right? So we'll let that be. For now, it really hasn't been an influential trade for the S&P 500 over the last little bit. Materials, just like, well, actually maybe not so much like home builders, they look okay. They honestly look okay here as a flag over the key level coming from this origin of the breakdown at 87.60. If we can get the Brigade bolt over 89.65, I mean, there's some thin structure to retrace over here. Although it looks bullish and the setup is potentially bullish here, what's the issue? I mean, this is literally the lightest weight sector for the S&P 500. Is it going to move the needle for the broad market? Probably not. Let's move along to industrials, 8% of the S&P 500, a little bit more meaningful. Chopping around in here, these sector charts, I'll tell you, they're not really the cleanest charts, and I think that that's okay, right? That's okay as the S&P 500 is stuck more so in a sideways range. It's does this resolve as a lower high, or does this resolve as a higher low? Sort of dealing with range compression over here, something along these lines. So depending on which way that breaks, we'll maybe get a little bit more information. In the meantime, I would just continue using this influence point at 138.25, inflection point, I should say, as your over or under. If we're above, more bullish for the S&P. If we're below, a little bit more caution for the S&P 500. Let's move along to communications, our final sector. Chart looks fantastic. I mean, come on, what more could you ask for this? Flat top highs. This is a heavier weight risk-on style sector. Maybe I shouldn't say heavyweight, but medium weight risk-on sector. If we can get the Brigade bolt, the blue sky territories, that's that rotation that we'll need if the S&P 500 is going to remain afloat in the situation where the XLK remains somewhat weak. So watching that quite closely, XLC over 103.75 could be the fuel that keeps the fire burning. Let's take a look over at the actual ratios in terms of performance. and see what we can learn. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. A decent recovery effort out of the XLK ratio to the S&P, but not a miraculous, like, oh my goodness, it's such a strong uptrend. Neutral, gets an X. This breaking down, XLY when I say this, through the 50 SMA gets an X. It's not bearish, like, oh my god, the downtrend is so, severe where the 50 SMA has rolled over completely. There's some overshoot happening here, yes, but it's definitely not helping the case for a bullish broad market. We talked about the structural chart just a moment ago. XLF still looks okay. We'll put a check mark there. This is a non-issue here. If we look at some of these risk-off sectors, though, like the XLP, starting to get a little bit more of a break of that 50 SMA. Same thing happening here with the XLU, which we've already made note are at the top end of the list for today's session. So is it time to neutralize maybe some of that bullish, oh my god, the market sellers can't drive this market to the downside, there's never going to be a crash, it's got to be all time, like, is it reasonable to dial that back to, like, okay, we've got a bullish edge, but, like, let's not get complacent here, and let's not just throw caution to the wind, let's not just start throwing money at the market like, oh, let's buy calls like madmen. Let's relax, let's take inventory of the data points. I think that this continues to suggest a little bit more of a bullish edge with a neutral undertone. Right, that's kind of the feeling I get when, given all the things we've seen so far in today's episode. Same thing happens here. Neutral, not really suggesting much. Neutral, not really suggesting much here. A little bit more of a breakdown, so maybe a cautionary statement there. This, neutral, not suggesting much. This sides with the bulls. So you've got one bearish, one bullish data point. Everything else is neutral. I'd say it's just kind of a neutral evening out, if you will, of all the considerations. As we move along to the dollar, what's happening with this? Dollar remains somewhat sideways up here, not really showing us a whole lot in terms of a trend. If we move along to gold, how's gold doing? It continues to suggest flight to safety. That neutralizes our opinion of a big bullish breakout potentially over these highs. Do we want to be aiming for a premature break? Not really when the gold ratio is looking like this. Let's move along to interest rates. Big break to the upside, obviously, this morning. Yeah, there it is. Interest rates moving over, and we saw this on the TLT gap down, but moving over, in this case, the neckline of the regular head and shoulders to the right shoulder. So one more time, is this helping the case for a bullish broad market? Not really. Not really. Lower rates are really going to spur more of that PE multiple expansion. We just don't have that out of the TNX as of this morning. Let's move along to the inverted ZT, speaking of rates, and the 2-year, which is what, the Fed basically, you could make the argument, does the dog wag the tail or does the tail wag the dog? 2 years right there at the breakout point. We have to start thinking about, I know it sounds crazy, we have to start thinking about the conversation of, like, no rate cuts at all in 2025 and then possibly pricing in rate hikes in 2026. If this breaks out, that's certainly what we should start thinking about. So instead of just thinking about it, let's have a look here at the Fed tracker tool ourselves. Let me give this a refresh. I'm just not sure if it has completely refreshed from this morning's update. Here we are. So a 97% probability of a pause in the March timeframe, which makes total sense. And notice that the rate cut got kicked out all the way to October. We were pricing in something as soon as June or July. It's been bumped out even further to October, which makes complete sense, right, with the hot inflation print that we saw this morning. We were also seeing the possibility of 2 rate cuts, right? There was one up here and there was one down here in October. That's completely off the board now, and now there's no rate cuts. You can see, one rate cut into the very end of 2026 that the market's pricing in. So all things considered, I think that the hot inflation print this morning really put the pressure on. The market doesn't seem to be responding to that all that much. Of course, here is the inflation report. If I just sort of close this up, you can see a couple of these metrics. Why is this not refreshed? Let's try that again. There we go. We have ourselves on the core, a miss, comes in 1/10 of a percentage point hotter. The non-core, 2/10 of a percentage point hotter, and 1/10 of a percentage point hotter here on the non-core year over year. If we look at the actual reading through the chart, we covered this in the pre-market prep. If you don't join those, you probably should. Generally, we saw an uptick in food inflation. We saw a downtick out of energy inflation, which was one of our theses from the Saturday update video. We were right about energy disinflation, but we were completely wrong about the other components, namely services over here, that drove things higher. Look at the 0.3 to the 0.5. That is a big uptick that can't go ignored. You can look at transportation services, huge upswing out of that cost there. The only thing, maybe that sort of keeps us in line with, okay, it's not all that bad. This will maybe get passed through, as in it's a seasonal thing and we'll move through that eventually. The only thing that suggests that is just that shelter inflation has not upticked to a, like, let's say something crazy like a 0.7, a 0.8, which, forbid that happens, because nobody wants higher cost of living, again, when it comes to the main component of CPI. So maybe these other things come down in the future, but Jerome Powell acknowledged it himself today. Rates probably just need to stay higher for longer. We've been talking about this thesis for a little while now here around the channel when it comes to these fundamentals, which is just that it's probably the case that after the sickness and everybody got locked inside, on the back side of that, we're not going back to an era of ZIRP, zero interest rate policy. We're not going back to an era of free money, right? And it's very possible that the market needs to find a higher neutral rate on the longer end of the curve, the 10-year, the 20-year, and the 30. So right now, I think that's kind of what the market's trying to do to get these things under control. So higher for longer from the Fed, and possibly even talking about no rate cuts should we start to see further inflation or persistent inflation later on in the year. We'll take that one meeting at a time, just like Powell does. One meeting at a time, we will remain data dependent. After the close, Reddit is down. If I'm not mistaken, we have Robinhood that is up. Robinhood has been making retail quite a lot recently. It's almost, it's one of those darlings, if you will, very similar to PLTR Palantir. I did not check in on AppLovin. I did not check in on the Trade Desk and Cisco, but they are reporting as we speak. Datadog before the open on Thursday. That's tomorrow. Of course, it always comes after Wednesday. Coinbase is interesting after the close on Thursday. Applied Materials for the semiconductor space. And don't forget about Palo Alto. I hate how they buried that in the list. That's what we've got on the earnings calendar into the remainder of the week. Let's jump back on over to the platform, though, and finish up our analysis through our risk on versus risk off sentiment charts. TLT ratio to the S&P got demolished today. So this is one of these charts where it keeps us on edge sometimes. This was neutralizing our opinion here. This breakdown, the lack of a higher low, if I do something that looks like this, technically closed underneath, to me, does not seem like a flight to safety trade yet. If it does produce a weekly higher low and takes this out, then we'll maybe start to have that conversation, something that looks like this. It just hasn't happened yet. So no flight to safety. The S&P is still the place to be when it comes to bonds versus equities. As we move along to bonds relative to themselves, no surprise that we're seeing an uptick here, and here with the hotter than expected inflation data. That one is self-evident. If we look at credit spreads, a downtick actually on the corporate side. This is the LQD side. The junk bond side, small uptick here, but still underneath the 50. I would argue that credit spreads have not done anything meaningful here to suggest we have a tightening of financial conditions. If we take, or an indication of volatility as well. You could really use that for both metrics. If we look at the HYG, it is somewhat divergent with this set of lower highs. I mean, yes, you have lower highs here, obviously not as steep. You could also make the argument that you have higher lows in the S&P versus the equal low over here. So something that you could watch as an additional indication intraday tomorrow and to the end of the week. Does the HYG break down underneath the equal low? And if so, you're probably looking for a weak move in the S&P 500. If it breaks the trend line to the upside and makes an equal high, you probably want to favor the upside out of the S&P 500. Remember that these things don't typically remain too disjointed intraday at any given point, and the bond market is typically seen as being the smarter of the two markets. Let's take a look at Bitcoin. BTC continues to get weaker on the Sailor Shift tool, but we have not broken down underneath the weekly shelf of support. Bitcoin really, there's a couple of trade ideas we have out there, Coinbase and MicroStrategy, namely being the two potential short ideas. If those two are going to go to the downside, you really need Bitcoin to break and Brigade bolt underneath this 92,000 mark to potentially move in for the retest of the 71.5. We're just not there yet. So one step at a time, and do just carry forward that the Sailor Shift is reading as bearish right now. Moving along to total breadth, we have seen so far this week a downtick out of breadth, small negative slope to that green line, negative slope absolutely in the blue line, and we are under the zero mark now out of the new highs versus lows. That's not helping the case for the S&P 500, but is it the end of the world? Not really. If you take a look at the RSP, we've once again gapped down into the top end of this range and rallied off of it. Need to continue holding 178 on the RSP. Moving along to the QQQE, again, not really the end of the world. Over 94 here. We could take a look at Dow Jones Industrials versus Transports, trying, not doing the best job, but trying to hold up over 16,150. How about volatility into the end of this week? We have the VIX still crushed down here at 15. I'm surprised, honestly, that this did not see a stronger move in the upward direction given the severity of the pre-market reaction to the inflation print. So I would carry that forward as a more bullish data point, or a comfortable data point. You could frame it that way for the market. VVIX also down towards the lows. Notice it gapped up over 103 but failed. That to me is interesting and important. So that's quite telling there. If we move along to the volatility futures and primarily use our top stack, this has been our go-to gem over the last little bit. Any inversions as of today's close, any inversions or moves towards the zero line? Is the back month starting to get a little bit frothy in terms of getting closer to the zero? No, nothing. No concerns out of this. So if I really think about the posture of volatility, it does not seem like an issue where the market is pricing in, oh my goodness, we should be crashing and burning. The ship should be going to zero. Let's get back on over to the main charts here. Let's take a look through our core list of companies, and then we'll get you on your way here after one additional trade idea. NVIDIA, you got to love it. 129, spot on the money. I think it is the low of today's session. What is the low? Take a look at this box right here. 129.08. Come on, off by 8 pennies. You got to give it to me. 129, beautiful level. And I'm not claiming to be the only one looking at 129. Don't get it twisted. We're just having some fun. It's the bottom end of the overhead supply. Beautiful pullback, higher low hold there. Anybody, shout out to anybody who is buying the pullback there. It was very, very fast, very, very quick off the 2-minute open. There was just 2-minute hammer right off the level, and then we were higher into the afternoon. If I look at this chart objectively, I mean, come on, this is a beautiful look below and fail. Target the top end of the range. Brigade Bolt now has the possibility to close the remainder of the gap off of 129. So a beautiful retest long opportunity off of 129. I would maintain that long stance as long as we're over 129. The only time I would flip short is if we get consolidation back under 129 and it gives an easy enough setup to identify that looks something along these lines. Left, head, right shoulder, and then maybe we'll play underneath 126.25. Maybe, right? But for now, base case is long as we're over 129. We'll see what happens as we move into the end of the week. Next up, Microsoft. Daily time frame chart here helps. We opened on a gap down underneath this key level here at 411.25. Gotta say, I'm not really thrilled with the Microsoft intraday price action. Tried to take the short on it on Tuesday. Didn't really work out the timing wise. This morning's gap down was like, okay, that's kind of what we were looking for off of the open, right? If you take a look at this, this opening drive here towards that 403.25. Regardless, let's not be hindsight traders. What's the deal here going forward? Name of the game is just continue. If it's going to remain bearish, right, is continue to suggest the lower highs under 411.25, set the equal low, and continue the stair stepping to the downside. We need a new lower low underneath this area. Now, if I look at the daily time frame chart, I don't know about you, but that looks more like a hammer candle off of a notable area of support, the bottom end of the range. And if there was a recovery over 411.25 to negate that base case for bears, you're probably dealing with what? Almost like NVIDIA, a look below and fail on the range low. So that's 411.25, an absolute must-watch level. Today's daily candle does give me some kind of, I don't want to lose sight that the daily trend is not overly. It's not trending. The daily chart is not trending. That's just the truth of the daily. But is it possible that you could get something that looks like this for at least a scalp? Excuse the whistle there. It's possible. It's absolutely possible. So we'll take Microsoft at face value, probably candle by candle as we walk forward, just because the daily chart is so sloppy. Here's the Apple daily. Apple, very strong close today. However, right at the weekly key level. It's got to show us something here. It's got to do one of two things. I really think that the pullback is already in place. If you take a look at the hourly time frame chart, you can see this. Let me zoom in here a little bit closer. There's your hourly pullback, right? This is the higher low that was set. This is the continuation. I would say that the next major hold needs to be over 234.75. If we can get a hold over that level, then fantastic. We're stair-stepping on the hourly in the upward direction. If you want to try to trade the breakout, oops, why did that not take? Why did none of that? Am I going crazy? Maybe. There we go. Let's try a gray dotted line. This is the next setup, right? That's kind of what I'm looking for here out of Apple if the buyers are going to remain in control. If this pulls back, the line in the sand has to be at 232.15, but this is ideal. This is ideal here. I would change my tone to being bearish if this does this, in which case we have left, head, right shoulder. 232.15 needs to fail if this is going to rotate down towards the lows. Let's take a look at Amazon. What's going on with Nancy here? It's rejecting its overhead range, so I'm a little disappointed because Amazon was just such a gift back here a number of times, breaking out of the daily bull flag. So a little disappointing to have to change up on Amazon, but we'll call the chart at face value. It's pulled back from the highest high in the trend count, but this actually starts to feel like a lower high on the multiple inside bars underneath this overhead supply. So 232.50 is the threat to preserve the more bearish stance that we might have now, and any equal low breakdowns here, the risk reward is the only issue with the downside, right? What are you going to do? You're going to short the range low? Maybe as an intraday scalp, this makes sense for something along those lines, but are you really going to be a short into the daily 50? You're going to be a short into this area of potentially support? I don't think that makes all that much sense. So I think Amazon is almost just kind of in a pass zone right now until there's maybe some sort of response off of the low at 225.25. So I'll be watching that most closely to see if buyers can step up and maybe offer some sort of move in the upward direction. Let's move along to Google. This chart, again, a lot of these charts, you got to be pretty picky about these charts these days when it comes to intraday opportunities. Otherwise, you'll get chopped up and eaten up alive. I want to go to a weekly chart here. And just continue to point out that if you could view this through a couple of different lenses. This is maybe cup and handle, in which case the top of the cup is the Willow Gap, 180.95, call it 181. So far, I mean, we're not really violating that retest of the previous breakout level from in here. But you also have to balance that with, okay, this is a daily range, and we've started to close daily bars underneath. If we go back to the daily time frame chart, you can see that, right? Here is the range we were just describing, and there's the close underneath. So sort of caught between a rock and a hard place. I would tend to always lean on the higher time frame charts to help out when it comes to direction. And, you know, my main idea would sort of, because of that, just be if we produce look below and fail, maybe we're interested in a move back over 185.25, trying to buy near areas of support and basically targeting the earnings gap down move from over here. That would be 192.50, closes up to 202.75. So we'll take that one step at a time, but that's kind of where I'm at with Google. Really just, you know, trying to be picky about the setups we take here and not getting ground around by the sideways broad market. Here's the metaverse. We talked about how this was looking somewhat tired up here. I still maintain that stance. I mean, the daily action is really not all that encouraging towards the top end of the range here. Yeah, you got an afternoon Brigade bolt holding above, but is there momentum in the name? Not really, not as that breakout's taking place. So I'm almost more inclined to say, whoa, not that zoom. I'm almost more inclined to say out of Meta, if we could spot a lower high back within range, not that you would need to take the short, but I would be more open-minded to like, okay, where can we finally get involved on a more meaningful pullback? This has been like running out of steam, grinding in the upward direction. The best long opportunity is likely going to come from some sort of hard reset where you either get a retest of these 3-day high breakout points. If you go even further than that, you could test these lows and maybe look for a reset off of that daily higher low. Keep in mind that the weekly chart can still afford something that looks like this off the daily 50 SMA and this flat top resistance at 635.25. Now, I'm not going to sit here and say that this is in play for tomorrow or the end of the week, but that's kind of the state of the chart right now. You're trying to buy this up here at the highest high in the trend count. Just understand that your trade location really isn't all that ideal. Let's move along to Tesla. Tesla offered a fantastic opportunity today. Thank you to Tesla on that. A little oversold from this waterfall, if you will, to the downside. I'm not saying it's bullish, but at least there was a counter trend opportunity. I do think that the upper wick from today's session is somewhat concerning underneath that 358.50. This is possibly a Brigade bolt lower high all the way to the bottom end of these lows at 310.50. Let's go down to the hourly time frame chart. It's that end of day breakdown that really sort of ruined the daily bar, if you will. So in terms of what's happening, it's an inside bar. It's an inside bar relative to the Tuesday range, and until we resolve that, I think that it's at this point probably a neutral play, given the end of day breakdown we've seen. If we get some sort of break that looks like this, maybe there's a scalp in the upward direction there, but one more time, I'd still respect 358.50 as a notable area of resistance, and possibly, the trade is risk reward back down towards the equal low, trying to look for a Tesla short up against that level. Something along these lines, risk, reward is what we just described. There it is on the daily. If the market's really going to turn around here out of Tesla, you have to see acceptance over that. And then I would even want to see acceptance over this flush point, right? 377. Or the flip side of this entire coin is that this extends way below 310.50 and then snaps back here for a double bottom higher low. And then we retrace, risk, reward, to the breakdown point, which is that 377. So there's a number of ways to trade Tesla. I think after today's inside bar, it's a little bit lackluster in terms of what the immediate setup is, but those are the levels that I would focus most on. JP Morgan looks fantastic. This was a gift on the Tuesday morning open right at the 270. Look at that beautiful retest. You could call this a double bottom. On Tuesday morning, we called this the Stevie Wonder, up and over 272. Off to the races. Kudos to anybody who caught it. Remember that this is helpful for the S&P 500, fueling the XLF sector as a whole. Netflix, what do we have with Netflix? Another beautiful chart that probably deserves to go into the history books. Take a look at this. Previous rejection, previous rejection, previous rejection, now acting as support. You could call it a double bottom in here over the neckline. Got interesting. Buying this got interesting at $9.99. The earnings trade breakout lives on. This is the idea that we're trying to capture. This is the idea that we're trying to capture. So far, so good. Bullish engulfer on today's session persists with the hold of 999. And speaking of financials, let's take a look at V. V for Visa is our trade idea of the day, and it's such a good trade idea we don't even have a level on there yet. Oh, did we reset this? Unfortunately, oh man, we must have hit reset the factory default by accident. Let's quickly throw this on, show on the right, and let's change this to 25 because you guys know the deal, round numbers only. There it is, up and over. Oof, we probably got to bump it up actually. Yeah, let's bump it up, 75, 75, show me 75. What do we get? Beautiful. There it is, over 351.75. You have a clear daily breakout level. You have all of this as mostly inside the range from the earnings high as well as the follow-up session gap down low. All of these are inside bars. If the range breaks out, blue sky territories up ahead. Let's take a look. Yep, there it is. Blue sky territories. I know this one for a fact. We can go max available for the sake of it, but Visa, an absolute monster of a company, and you know it if you have to pay those processing fees every single time someone wants to transact via credit. You could probably take a look at MA and see if there's a sympathy move over here. Chart doesn't look as good. Chart really does not look as good out of MA. A couple of different, let's go RDDT for Reddit. Quickly take a look at some of these earnings names for you just because there was only one trade idea, RDDT. You can see big move lower here into a potential area of support. Let's go daily. This is back down at 181.85. Huge retest level actually for tomorrow morning's open. If this can hold up around 181.85, this could be a great retest long entry for a weekly Brigade bolt. All right, so that's not a recommendation. You do whatever research you have to do to come up with an opinion, but from a technical point of view, what a beautiful level here, 181.85 on Reddit. The other one was AAP. Sorry, that's Advanced Auto Parts, rather APP for app 11. Big gap up here, that's blue sky territories out of app 11. Kudos to anybody who's long that name. I would not chase the balloon up here. If you're long, great. If you're not long, let the balloon go. Let it float away. There will always be more opportunities. What was the other one? We want Hood, Robin Hood. Another gap up, all these IPO opening breaks, right? Beautiful, beautiful charts. IPOs, we've been tracking this probably since early November when these rallies were really starting to like put the pressure on, and we've seen nothing but continuation. Both Reddit as well as Robinhood now getting that continuation. Just great looking charts here. Palantir as well, another retail name that has been absolutely phenomenal. So that is going to do it for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live tomorrow morning for our pre-market prep, 8 o'clock Eastern time. Come tune in. We have PPI at 8:30, Producer Price Index, another measure of inflation. We will have coffee and donuts for you up here in the office. We hope to see you there. With that said, have a green trading week.